So you've decided to become a trader. That's awesome. You've probably already imagined turning $100 into $10,000 by the weekend, right? But here's the plot twist nobody told you about. Risk management is the boring superhero that actually keeps you alive in this game. Seriously, this one topic that seems almost too basic is the main reason most people blow up their accounts faster than they can spell leverage. Segment 1. The basics of risk management. Keeping it simple. Let's break it down like this. Risk management isn't rocket science. In fact, it's kind of boring. You basically just always use a stop loss, never risk more than 1 to 2% of your capital on a single trade, maintain at least a 1 to 3 risk to reward ratio. And that's it. That's literally the whole concept. So why does everyone struggle with it? Because implementing it consistently is where 99% of beginners fail. The 1% rule, and how to grow it safely. Now, I know what you're thinking. Only 1%? That's peanuts. I won't make anything. Yes, 1% sounds small. And it is. But it's not about the size, it's about survival. Take that 1% as your starting point. Then, as you trade for at least 6 months with discipline, sticking to your plan, journaling every trade, and you notice things are going well, you can consider increasing it to 1.5% or 2%. But, and this is non-negotiable, before increasing risk, go through your trading journal. Look at your drawdowns and losing streaks. Assess how different risk levels would have impacted your account. Risk isn't one size fits all. Your risk tolerance should evolve with your experience and your data, not your emotions. Let's talk about the risk to reward ratio. On paper, a 1 to 2 trade looks good, but once you factor in fees, it's usually not. Here's what really happens. Your losing trades might lose 1.1 to 1.2 R due to fees. Your winning trades might return only 1.8 to 1.9 R instead of a clean 2 R. So a 1 to 2 trade on chart often becomes closer to 1 to 1.5 or worse in your actual P&L. That's why you should aim for a minimum of 1 to 3 RR, especially as a beginner. It gives you breathing room to stay net positive even if you're only right 40% of the time. Dynamic risk. Don't get too fancy too soon. Now let's talk about dynamic risk management. The idea of risking more on high probability setups. Sounds smart, right? Well, not really. At least not for the first few years. Because here's the trap. You might end up risking more on a losing trade and less on a winning one. Why? Because you can't know which trade will win. It's a probability game, not prophecy. Dynamic risk completely ignores that every strategy, no matter how good, has losing trades. Avoid complicating it. Simple works. Even the greatest traders who've lived, the ones with books written about them, kept their risk consistent. They weren't trying to be cute with dynamic sizing. Segment 5, final words. Stay in the game. Look, I get it. Risk management isn't exciting. You won't see reels about it. There's no dopamine hit. But if you don't master this boring stuff, you'll never make it to the fun part, which is growing your account. So to wrap up, start with 1% risk per trade. Trade with discipline for at least 6 months. Journal everything. Increase risk only when you have data backing it. Aim for minimum 1 to 3 RR. Forget dynamic risk for now. Never skip stop loss. This is how you survive the learning phase and actually make a living from trading. And that's what this game is all about. Survival first, profit second. All right. If this helped you out, smash that like button and tell your future self thank you in the comments, because trust me, he's going to be grateful you learned this stuff early. See you in the next video. And remember, boring traders live longer.